In this video, we're going to talk about the relationship between what's referred to as an intrinsic value and market prices. Market prices, to begin with, are created by a supply and demand mechanism. Supply is created by the corporations. They provide shares for us to buy. The demand is created by the investors as a whole. Intrinsic value is what we as individuals predict, right? These are predicted prices. The predicted prices will rarely ever be equal to the actual market price. Why is that true? It's true because of the information that's there, right? All the relevant and available information is different for predicting prices than it is for the investing public, right? Essentially, what we have is a system where some people in the economy know more than others. It's all about information. So, what's required for the market to be in equilibrium? Again, market price has to equal intrinsic value. So, again, the expected return, right, has to be equal to the required return. So, how is equilibrium established? If the market price is below the intrinsic value, right, the expected return, again, is above the required value. As investors, we're going to see this as a bargain, and we're going to want to buy that asset. And if all of us start buying, that obviously drives up demand and increases the price. So this profitable trading, right, is going to continue until we get to equilibrium. And of course, the exact opposite happens if the relationship between intrinsic value and market value are switched. Now, there's a theory that tries to explain this. It's called the efficient market hypothesis. And as it says at the top here, it's all about the information. So what this efficient market hypothesis tells us is that when new information comes to us as investors, we evaluate it, and very quickly a new equilibrium price is created. Because there's lots of people looking at stocks, the new information gets to professional traders much quicker than it does to the average person. And of course, if some mispricing occurs, then there's this trading that is going to eliminate that mispricing. So the efficient market hypothesis says that in general, stocks should be in equilibrium because people will trade differences away. Another aspect, or what this means, is that a person cannot beat the market by consistently earning a return higher than what's justified by the stock's risk. So what this is just saying is you can't beat the market if stocks are in equilibrium because the price and the actual intrinsic value are equal. So the calculation of this is what's referred to as the excess return. You take the actual price and you subtract out the expected price. Now, this has sort of confused me over time, right? So this is not saying you won't make any money. What this is saying is you cannot, on average, beat the stock market every single time. And when I say beat the stock market, I'm talking about the risk-adjusted return on the stock itself. So we want to test whether or not this theory makes sense. Well, how do you do that? Well, we need to have a trading strategy, and we implement that over a large sample, and we try to find out if the actual returns are greater than the required returns as stated by the pricing model we choose. So if actual is greater than required, we would reject this efficient market hypothesis. Notice that again, this is really two tests in one. I kind of talked about this a little bit earlier, right? So how can this exist? Well, it exists if number one, if the market is not efficient, but it also could be a test of the asset pricing model itself. And capital asset pricing model and several other theories, they all have some challenges. They all have some issues with being used in the public. So the first test we have is what we refer to as the weak form test. And essentially, the weak form test looks at historical prices. The test says current prices already reflect all the information from the past. So if you're using current prices as a marker of whether to invest in something or not, for instance, a strategy might be invest in stocks that have declined below their previous 52-week low. I mean, this kind of makes some sense, right? Why is it so low? Well, there's only two reasons why the stock price would be low. In fact, below its previous week, 52 weeks. Either the company is in real trouble and it's got issues, or it's mispriced. If it's mispriced because the price is low, if you buy it, hopefully the price will go up. Again, this is kind of a technical analysis question. So most evidence supports this weak form. Essentially what it says is, in general, using historical prices and information is not beneficial in trying to pick good and bad stocks. Now, again, there are some exceptions, right? Measuring momentum and measuring some long-term reversals, utilizing those variables and those kinds of events have shown some, although not great, some ability to earn a little bit extra return if you can identify them quick enough. The second strategy, or the second form, is called the semi-strong form. And essentially what this is saying is that current prices have all publicly available information. So again, it doesn't matter what kind of information you have, you can't use that information from financial statements, public sources, historical data, right? You can't use that to beat the market on average all the time. So essentially a strategy could be you're going to invest in stocks with a past 3-year annual earnings growth greater than 10 and a ratio of research and development to sales that's greater than 10. This is what refers to as type of fundamental analysis. So again, if you chose that, again, if that's your strategy, do you on average beat the risk-adjusted or the pricing model's expected return for the asset? Most empirical evidence supports this form, says that you can't beat the market. In fact, there's a vast majority of portfolio managers that do not consistently have returns in excess of the CAPM predictions. That's just the way it works. But there are some exceptions. Small companies and companies with high book-to-market ratios tend to have higher returns on a risk-adjusted basis than their counterparts. So companies with high book-to-market ratios or low market-to-book ratios earn higher returns than expected. Also, we find this to be true with PE ratios. Typically, you would want a PE ratio for a stock you want to buy to be lower rather than higher. It implies a relationship between the price and what the intrinsic value should be. The third form is what's referred to as the strong form. And this form says, even if you have inside information, you can't earn excess returns. And this is just not true, right? So again, if you know inside information and you trade on that, you should win every time. You should always make a decent rate of return in excess of the risk-adjusted base. But then you may be looking at some jail time, right? So that's why inside trading is not is frowned on, is because it's not really investing. If you know who's going to win the race, right? It's not investing. There's no chance you could be wrong. Now we have a variety of issues that contradict some of this efficient market hypothesis. Sometimes we refer to these as anomalies, or there could be bubbles, right? There's something in the market that's creating this distinction, if you will. That, prices are rapidly growing to where most people say, it's never been there before. How is that possible? We have lots of trading volume, many new investors looking into the market, right? And then eventually what happens? The market, the bubble bursts, and then prices suddenly fall. What does this tell us about this efficient market hypothesis? If there is a bubble, why don't people trade on it, right? Or if these anomalies exist, wouldn't trading get rid of them? The challenge is it's difficult to recognize a bubble until you got it, right? So trading strategies will expose traders to possible big losses if the bubble is kind of slow, right? So it can be fast, it can be slow. If it's difficult to recognize, how do you protect yourself against it? So the bottom line on market efficiency is, in general, it's pretty safe to assume that the market is reasonably efficient. Lots of investors don't even try, right? This is why maybe that the index mutual funds and investing in indexes has become so popular. You just don't want to bet on the individual things. Bubbles do occur. They do occur infrequently, but they do occur. The empirical test of the capital asset pricing model, since that could be an issue with why things are not in equilibrium, also have some problems, right? Most companies use CAPM to determine their stock's required return. Most researchers, though, use a multi-factor model, right? They utilize more than just the beta of the company. They use other characteristics. And we'll talk about this in some later videos. So the statistical tests have problems with verifying the empirical soundness, if you will, of CAPM. Investors' required returns are based on future risk, but beta measures historical data. So we're looking forward, but analyzing from the past. Investors also are concerned about both standalone and market risk. If you don't have a well-diversified portfolio, then you may have a concern also about standalone risk, not just market risk. So there's lots of issues with the capital asset pricing model and trying to understand whether the differences in prices that we see between price and intrinsic value, is that because it's mispriced, or is that because the model that we're using for the market value or the intrinsic value, that pricing model itself is flawed? And unfortunately, we don't have an answer for that. So that's it for this video. See you next time.